Hey there, fellow investors. Welcome to the thrilling world of finance, where every decision can lead to a fortune or a lesson learned. Let's talk about earnings season, that magical time when companies open their books and reveal their financial secrets. It's a period filled with anticipation, excitement, and sometimes a bit of anxiety. It's like Christmas for investors. Just imagine the joy of unwrapping a gift. But instead of toys or gadgets, you get valuable insights into the financial health of your favorite companies. We finally get to see how our favorite companies performed over the past few months. Did they meet expectations? Did they exceed them? Or did they fall short? These are the questions that keep us on the edge of our seats. Earnings season happens 4 times a year, and it's a big deal. Each quarter, companies release their earnings reports, giving us a snapshot of their financial performance. It's a time when the market is buzzing with activity, and every investor is paying close attention. It's when we get the most up-to-date information about a company's financial health. This data is crucial for making informed investment decisions. Whether you're a seasoned investor or just starting out, understanding earnings reports can give you a significant edge. Think of it as a report card for businesses. Just like students get graded on their performance, companies are evaluated based on their earnings. These reports can influence stock prices, investor sentiment, and even the overall market direction. During earnings season, companies announce their quarterly earnings reports. These announcements are often accompanied by press releases and conference calls, where executives discuss the results and provide guidance for the future. These reports tell us how much money they made, or revenue, and how much profit they earned, or net income. They also provide insights into other key metrics like earnings per share, operating income, and cash flow. We get to see if they're growing, struggling, or just cruising along. Are they expanding into new markets? Are they facing challenges that could impact their future performance? These are the details that can make or break an investment strategy. So buckle up, because earnings season is a wild ride. The market can be incredibly volatile during this time, with stock prices swinging up and down based on the latest earnings reports. It's a time of great opportunity, but also great risk. Get ready for market swings, analyst chatter, and plenty of opportunities to make some money. Whether you're looking to buy, sell, or hold, earnings season is the perfect time to reassess your portfolio and make strategic moves. So stay informed, stay vigilant, and most importantly, stay excited about the possibilities that lie ahead. Transparency is key in the financial world, folks. Without it, investors would be left in the dark, unable to make informed decisions about where to put their money. Transparency builds trust and confidence, which are essential for the smooth functioning of financial markets. During earnings season, companies give us a peek behind the curtain. This is when they release their financial statements, providing a detailed account of their performance over the past quarter or year. It's like a report card for businesses, showing how well they've done and where they might need to improve. They show us how they're making money, which is revenue. Revenue is the total amount of money a company earns from its normal business activities, like selling products or services. It's the top line on the income statement and a key indicator of a company's financial health. But revenue is just one piece of the puzzle. Companies also disclose how much it costs to run their business, which are expenses. Expenses include everything from salaries and rent to utilities and marketing costs. By comparing revenue to expenses, we can see how efficiently a company is operating and how much profit they're left with, or net income. Net income is the bottom line on the income statement, representing the company's total earnings after all expenses have been deducted. It's a crucial measure of profitability and a key factor in determining a company's financial success. Think of it like this: revenue is like the total amount of money you earn from your job. It's your gross income before any deductions. It's the starting point for understanding your financial situation. Expenses are like your bills, rent, and daily coffee fix. These are the costs you incur to maintain your lifestyle. Just like a company, you need to manage these expenses carefully to ensure you don't overspend. And profit is the money you have left over after paying all those expenses. It's your net income, the amount you can save, invest, or spend on discretionary items. For companies, this profit can be reinvested in the business, used to pay dividends to shareholders, or saved for future needs. Companies also reveal their cash flow, which is the actual cash coming in and going out. Cash flow is different from profit because it focuses on the timing of cash movements. A company might be profitable on paper, but still face cash flow problems if it doesn't manage its cash effectively. It's like tracking your spending and making sure you have enough money in the bank to cover your expenses. Cash flow management is crucial for both individuals and businesses to avoid running into financial trouble. This transparency is crucial for investors because it helps us make informed decisions. By understanding a company's financial health, we can assess its potential for growth and profitability. This information is vital for making smart investment choices and managing risk. We can see if a company is managing its money well, growing its revenue, and generating strong cash flow. These factors are essential for long-term success and can significantly impact a company's stock price. Transparency in earnings allows investors to have a clear picture of a company's performance and make decisions based on solid data rather than speculation. Moreover, transparency fosters accountability. When companies are open about their financials, they are more likely to be held accountable for their actions. This can lead to better corporate governance and more ethical business practices, benefiting not just investors but all stakeholders, including employees, customers, and the community. In today's fast-paced and interconnected world, transparency in earnings is more important than ever. With the rise of social media and instant communication, any hint of financial mismanagement can quickly become public knowledge, damaging a company's reputation and stock price. Therefore, companies have a strong incentive to be transparent and honest in their financial reporting. For investors, understanding the nuances of financial statements and earnings reports is a valuable skill. It allows us to see beyond the headlines and get a true sense of a company's performance. By digging into the details, we can uncover opportunities and avoid potential pitfalls. So the next time you hear about a company's earnings report, take a closer look. Pay attention to the revenue, expenses, net income, and cash flow. These numbers tell a story about the company's financial health and future prospects. And remember, transparency in earnings is not just about numbers. It's about building trust and making informed decisions. In conclusion, transparency in earnings is a cornerstone of the financial world. It empowers investors, promotes accountability, and fosters trust. By understanding and valuing this transparency, we can make better investment decisions and contribute to a more stable and ethical financial system. Hold on tight, because earnings season can be a wild ride for the stock market. When companies announce their earnings, investors react instantly and stock prices can soar or plummet. Why the drama? Well, if a company reports strong earnings that beat expectations, investors get excited and rush to buy the stock. This demand pushes the stock price up. On the flip side, if a company misses earnings estimates, investors might sell their shares, causing the stock price to drop. It's all about supply and demand, folks. Earnings season creates a frenzy of buying and selling as investors react to the latest news. That's why you'll often see big stock price swings during this time, so buckle up and enjoy the ride. Just remember to stay focused on the long-term fundamentals of the companies you invest in. Here's the deal. Wall Street analysts are always trying to predict how companies will perform. They spend countless hours poring over data, analyzing trends, and making forecasts. Their goal is to provide investors with insights that can help them make informed decisions. They release earnings estimates, which are basically educated guesses about a company's revenue, earnings, and other key metrics. These estimates are based on a variety of factors, including past performance, market conditions, and industry trends. But here's the thing. Sometimes companies exceed these expectations, and sometimes they fall short. When a company exceeds expectations, it often means they've managed their resources well, capitalized on market opportunities, or innovated in ways that analysts didn't anticipate. It's all about beating the buzz. When a company beats earnings estimates, it's a sign that they're performing better than expected, and investors get excited. This excitement can lead to a surge in the company's stock price as more investors want to buy in. If a company beats earnings estimates, it's a sign that they're performing better than expected and investors get excited. This can create a positive feedback loop where rising stock prices attract more investors, further driving up the price. On the other hand, if a company misses earnings estimates, it can be a red flag for investors. This might indicate that the company is facing unexpected challenges, such as increased competition, higher costs, or declining demand for its products or services. It might mean that the company is facing challenges, or that its business isn't growing as quickly as analysts had hoped. This can lead to a drop in the company's stock price, as investors lose confidence and start selling their shares. That's why it's crucial to pay attention to both the actual earnings numbers and how they compare to Wall Street's expectations. Understanding this dynamic can help investors make more informed decisions about when to buy, hold, or sell a stock. It's all about understanding the story behind the numbers. Each earnings report tells a story about a company's performance, its challenges, and its future prospects. By digging deeper into these reports, investors can gain valuable insights that go beyond the headline numbers. Analysts use a variety of tools and models to make their predictions. They look at historical data, market trends, and economic indicators to build a picture of what the future might hold. This process is as much an art as it is a science, requiring both analytical skills and intuition. For individual investors, staying informed is key. Following financial news, reading analyst reports, and keeping an eye on market trends can help you stay ahead of the curve. It's also important to remember that no prediction is perfect, and the market can be unpredictable. Different investors have different strategies and risk tolerances. Some may be more focused on short-term gains, while others are looking at long-term growth. Understanding your own investment goals and risk tolerance is crucial in navigating the ups and downs of the market. Working with a financial advisor can also be beneficial. Advisors can provide personalized advice based on your financial situation and goals. They can help you interpret earnings reports, understand market trends, and make informed investment decisions. Education is another important aspect. The more you learn about how the market works, the better equipped you'll be to make smart investment choices. There are many resources available, from online courses to workshops and seminars. Ultimately, the goal is to build a portfolio that aligns with your financial goals and helps you achieve your dreams. Whether you're saving for retirement, a home, or another big milestone, understanding the expectations versus reality dynamic in the market can help you get there. So the next time you hear about a company's earnings report, remember to look beyond the numbers. Consider the context, the expectations, and the reality. This deeper understanding can make all the difference in your investment journey.